So a lot depends on your financial needs, of course, what the market is doing. People used to refinance, usually the normal trigger is, hey, rates went down. Doesn't mean it makes sense to refinance. You could do refinance to do three different things. One is to reduce your payment, which is not always the best situation. Two is to cut your loan term by either keeping the payment somewhat similar to what you have or a little bit more. And I'll give you a couple examples on those. And third is to take money out the equity to do whatever you want to do with it. So a lot of people back in the times used to do it to pay for college for kids, or making home improvements, or investing money, or getting divorced. They need money to pay off their spouse. So those are the top three things. But let's focus on the second one. That what really makes sense in terms of refinancing to cut your loan term. So for example, let's say you have a 30-year fixed loan at 3.25, and you had that loan for last 5 years. And now the rates are 2.75, 2.65, or 2.5. Does it automatically mean you should refinance? If you would have called me, I would have probably told you no. Why? Because you have already paid interest for those 5 years. And when you're refinancing, you're resetting the term only if you did the 30-year fix. So what I usually recommend when people are refinancing, hey, how do we keep the payment about the same? And now you have 25 years left. How do we make that 20, 21, 15? So that way, all you're doing is you're taking the burden of interest and transferring over to principal, which means you're building your equity faster. So these are the more technical things. I wish I was in person and could show you numbers and everything. But I can tell you from when I get the calls, their first question is, what's the interest rate? That's it. There's no details, no nothing. That is the very wrong approach. That is the worst approach to take, because no bank will tell you not to refinance. They don't care if you're paying more interest. They don't care what your family situation may be in the future. They just want to make money and move on. They take advantage when the market is going down. I have clients that call me and I tell them, hey, don't do refinance. It doesn't make sense. And guess what? They don't like the answer. They go somewhere else because interest rates are low. Their friends are doing it and they want to do it. So let's take a very simple example. Let's say you have a mortgage and you're making $2,000 payment right now. And you had it for 5 years. Now rates went down and we refinance and we're looking at 15 or 20-year fixed. And if your payment goes to $2,800, for example, so it went up by $800, but you could have took the same $800 and kept paying on your existing loan, and that would have probably get you to 15 or 20-year fixed as it is. So why go through the hassle of doing it? Now, if that payment would have went up to $2,100, $2,200, and that cuts your loan term by 5, 6, 7, 8 years, it totally makes sense to do it. Because that's when you're really saving the interest over the life of the loan in the long run. So far with me? Does that make sense, or I'm kind of confusing it? Can you guys hear me?
Yep, I think, yeah, that's good. Mm-hmm.
Does that make sense what I'm trying to say?
Yeah.
You basically you are cutting the loan term, and by cutting the loan term, you are saving on the interest.
Correct. Now, a lot of people, and I totally get our culture, even when I got into this business, it was like, I don't want to have loan, I want to pay it down. That is not always the best case either. When you're doing a 15-year fix compared to 30-year fix, and people think I'm going to save interest over the life of the loan, yeah, myth is yes, but the answer is no. Why? Interest is only applicable until you have the loan. Nobody stays in their property for 15 years, 30 years, 20 years. Everybody rotates their loan every 4, 5, 6 years. That's because of either they're buying a new home, they switch the jobs, or rates drop, or they need money again. So interest is only applicable until you have the loan, not the entire term. So long story short, the whole thing, what makes sense, it's different for everybody. What I focus on, I don't focus on interest rate. I focus on what makes sense given your lifestyle right now. If somebody is 30 years old, their refinance situation might be different than who's 50 years old, who is 40 years old. I look at how old are they, if the spouse is working or no, how old are the kids, any changes in life that may be coming in next 5, 6, 7 years, think about those changes now and make a financial decision based on that. Mortgage is not everything in your life. It's just piece of the puzzle, not everything. Everybody does 15-year fix, they pay down, they pay down, they pay down, and when they lose job and something happens, now they're stuck with it because every penny they had, they put it in the mortgage. Put that money in other places, 401k, IRA, HSA. Take those advantage of the tax. Because if you put money in IRA every year, you get 30% tax deduction, right? So instead of putting it towards mortgage and saving interest, you can take 30% tax deduction right away. So key is to have overall balanced solution. So when those things happen in your life in the next 4, 5, 6 years, 7 years, you are very well prepared because I don't know what the rates would be next 4, 5, 6, 7 years, right? You can do 15-year fix right now and take 2.25, 2.375, and you pay down, kids are ready for college, and now you need money. Then you want to be calling somebody again to take the money out, and who knows what the interest rate at that point would be, right? So rather do 30-year fixed, pay more when you can. If you did a 30-year fixed loan right now compared to 15, and you made the same exact payment like 15, your loan will be done in 15 years and few months. So why obligate yourself of making a bigger payment? When you have the leverage, if you lose job, or if kids going to college, or you may have to go back to India, right? You have the options open. Don't lock your options with the bank. Keep your options with you in your hand. Don't let the bank dictate your finances in the future. You should be in control. Does that make sense?
Yeah. So basically, basically,
Right.
Vibhu, what you are saying is, for the main takeaway was, even if I, let's say I have a previously 30-year loan with a 3.5%. Now I can take a loan with a 2.75%. But as long as I save the money for, in IRA or something, that is also, we can do that, right?
Correct.
Money somewhere.
Just have the overall balance approach. Simple example is, I'm sure we all are married over here. We all have kids, right?
Yeah.
We need, when it comes to buying a car, you think about all those things, right? Hey, I need a family car. I need this. I need that. I'm going to go buy a Honda Odyssey, right? You're not going to go buy a sports car unless you have too much money to have an extra car. So your 30-year fix is really your Honda Odyssey. Your sports car is your 15-year fix, which may look pretty cool to begin with, but in the end, it's not going to, because you will get over it and you will want to go back to Honda Odyssey when you're traveling with your family. So I'm going to let you guys ask me more questions, to be honest with you. I think that would make more sense. I would rather focus on specific questions you have. And I can keep going on all these things, and it'll be very hard to do everything in one seminar. So I won't mind doing a follow-up if you guys need it.
Yeah.
So go ahead, fire some questions, and then I will also cover behind the scenes, how different lenders are different, what's in the market, what really goes behind the scene in the mortgage company, especially nowadays, and how to really pick the right lender. That's the most important thing. So, but go ahead, fire me some questions.
Vibhu, we have some questions from the members. So I'll read them one by one and you can go ahead for now. Okay, so have a couple of clarifications on the process of doing a refinance and the interest rate for my current home loan. So that is what the question is.
Yeah. So it's kind of similar to what I was going to cover. So the interest rate, it is a moving target every day. I'll be honest, I did my refinance about 4 months ago after 9 years because I barely got time to do it myself. And this time I had to do it because my friend said he would help me. And believe it or not, I cannot even do my own refinance through my own company because there is a conflict of interest. It's very shameful, but I could have got a better deal, but I didn't. So when it comes to interest rate, it is a moving target every day, every second. If you have a rate of 2.25, doesn't mean the other person gets 2.25. It is very specific to loan amounts, value, credit score, zip code, type of property, type of banks we deal with. At the end of the day, think of this as gas price changes every day, right? One gas station may have it for $2, other may have it for $2.02 or $1.98. Everybody's buying those gases every day depending on how much their requirement is. Now, if they bought a gas and gas price went up, those people are making money, right? Or if gas price go down, they're losing money. So it's a market instrument. It's impossible to time it. You cannot say, hey, I got the best deal on X date and market goes down. Well, that best doesn't exist anymore because market went down. And it is impossible for us to, as a lender, to get the new rate because when you're locking a loan, we're buying money on your behalf from the market that day. And the money has a cost, so we already paid for it. And when rates go down, if we go back to the bank that, hey, give us a new thing, they won't. They would basically shut us down. So you know how this thing works. So when consumer says, I got a better deal now, well, that's not because the other person had a magic stick. They have a better deal. No, because market went down. So you can never time it. It's impossible to do that. And that's the reason we are putting out a new tool that would be on our website in next month and a half, where our consumer will be able to check markets every day live. You don't need me, you don't need us at all. Most lenders hide that. Reason for that is they want them to call in and try to find out what's really the aptitude of the customer. Are they shopper, they're not shopper, how to bring them, how to make, basically their goal is to make the most amount of money they can. So example for that, let's say 15-year fixed. If your credit score is 620 compared to 800 and you're doing a 15-year fixed mortgage, it makes no difference in the interest rate. Banks won't tell you that. If they see, hey, you walk in, you're applying a loan, you say my score is 700, it comes out to be 650, they're going to charge you more. But it does not cost them more when they're buying that money from the market on a 15-year and a 10-year fixed. It does cost them more if you're doing 30-year fixed or 20-year fixed or any kind of ARM loans. So long story short, guys, it's impossible to time the market. Not one loan is same as the other. Everybody says, yeah, my friend got this. Well, yeah, their specification was different than yours, and their lock rate was different than yours. You cannot compare the two. Does that answer on how to shop?
Yes, we will. Yes. So what
and
is
one thing is, go ahead.
Now, what is the process, refinance process? That is one of the members' question was, what is the process for doing refinance? You start with what are,
Sure. So on the process side, of course, it all starts with loan quote. You shop, you make sure what you got is what's the best that day. Because if you don't shop, you won't know the shopping is good just to get an idea what's going on in the market. And then once you get done with shopping, we do the loan application. We, on our end, we do the credit check. But that's the very initial step. But behind the scenes, guys, every loan can take at least minimum 10 to 20 to 30 hours of work, because we have to do a lot of regulatory things. We have to follow a lot of laws. We have to verify your income. We have to verify your bank accounts. We have to verify your social security, your income with IRS. There are a lot of paperwork behind the scene that we have to do that makes it very cumbersome. Now, technology can help to offset it. So, for example, on our website, if you go apply, and if you work for one Fortune 500 companies, most likely we verify your income and assets at the spot. But behind the scene, there's a lot of things that we have to do with paperwork, ordering title. Title company depends on counties. Like right now, some counties are very slow because the amount of business coming in and they were shut down. So process is very, very, very cumbersome. But give me more technicalities. If you have any examples, I mean, I can talk all day long about specific of this document, specific of that document. Again, that changes on loan to loan too. So for example, if somebody is self-employed and now we got to verify all their income, how do we go about verifying the income of self-employed? They can make whatever numbers they want to, right? We have to get tax returns. We have to verify all that with their CPAs. We have to make sure their business is registered with the state. We have to make sure there is no fraud going on. So we verify all those things from so many different resources. We know more about you than what you think. Trust me. There is nothing and any customer can do to hide anything. We will find out. We have a lot of tools we use to find every single bit of information we can. And we have to do that by law before we sell the loan. All these loans goes to Fannie Mae and Freddie Mac, which is a government entity. And if you have any questions about that you're not sure, your bank is asking or what's going on, it's very simple. Go type in Fannie Mae loan guidelines and you will see 1,200 pages of document that we have to basically memorize on day-to-day basis in order to do loan.
Wow.
But once you do application, you upload the documents. This is all in the nutshell. You upload the documents. We review all the documents. We order appraisal if appraisal is needed. We order title paperwork if title is needed. We make sure we verify your income, your social security, your driver's license, anything to do with your income, asset, collateral, ID, social. We have to do all those verifications.
Hey, Bhubadi has a question. Prabhakar, can you, Bhubadi is mute. Can you take it out?
I think he himself can take it out.
Bhubadi,
can you try it out? Can you unmute and speak?
Yeah. Oh, yeah.
Yeah, sure. Thanks. Hi, Vibhu.
Hey, how are you?
Good, sir. How are you?
You're looking good. I like the color.
Thank you. Already I got compliment over the WhatsApp from few people. Yeah, we have to be contrast now. Anyway, so
yeah.
thanks for the information. Yeah, this is a potential information in this situation. People can avail this better rate. So my question, what I just put to committee was like, how long will it take to close with the current overwhelmed new or refi applications? So in addition, will it take? Will it differ between new and will it differ between new purchase versus refi?
Yes, it does. So industry-wide focus is always priorities purchases. Why? Because a lot of people are depending on moving. There are too many moving pieces when it comes to somebody buying home. They're selling their previous home that has been bought by somebody else. Sometimes we have seen transactions where there are people buying, selling, but whoever is buying their previous home, they're selling their home. And then if somebody else is buying their home, it's like a chain of people. If one thing gets off track, it falls apart for everybody. So to answer to your question, purchases are more priority. We can do them in 30 days, even faster, depending on the type of loan and where it is, what type of documentation is needed. If it's W-2 employee, it's much easier than self-employed. So that takes priority. Kind of refinance become non-priority at that time. And a lot of banks focus on more purchases and they try to ignore refinances. But right now, refinance volume is so much that it's getting hard for us to get to the purchase. Think of this. We used to have, I'll give you my own prime example. We used to have on any given time 100 clients, right? So we close 60, 70, 80 a month. We were built for that. Now we got 550 customers. Everybody has their own different workflow. Everybody wants to get their stuff done, loan done in different time frame. All day I get texts, what's the status, what's going on, this and that. We getting bogged down because of that rather than really doing an actual work. So it's hard to prioritize even purchase in this environment because we just keep getting calls and calls and calls. But to answer to your question, we can do purchase in less than 30 days as long as we have everything ready to go. On refinance, 60 days. And that 60 days doesn't mean it is 60 days. There are times when we close loan in 20 days because customer did everything what we expected them to do. Right? But now we have customers who are calling us or some complexity comes up out of nowhere. I have a client right now who did refinance 2 times in 2003 and 2013, and now he's doing it for the 3rd time. We did his loan in 3 weeks, but last minute hiccup is when he did the refinance the last time, they never released those mortgages. So when we did the title work, technically he has 3 loans on the title. Now, that transaction went from being very simple to very complicated, which he was not even aware of, that he had technically 3 loans outstanding against his property. Now we have to go chase documents from the bank from 2002, which doesn't exist because they got sold off. So it's a huge problem for him, and we're helping him to fix it. That would take hours and hours and hours of work to do.
I see.
So that's what throws everything off in the cycle. Now, which one to focus? If we ignore that person, it's very important for him to fix that because he's all stressed over. Technically, he owes $700,000 on a $300,000 home. Right?
Gotcha. Okay.
So there's a lot of things behind the scene that customers don't get to see. And good thing is refinancing, so at least now we can fix it. So going forward, you won't have that issue because when he did in 2013, basically whoever the company was, I won't name it, they're like, it's not our problem. We just did what we had to do, move on. Because technically, legally, you cannot go after that. They ignored the whole thing.
That's new.
Because the bank, yeah.
Okay.
Yeah.
I have a question. How to minimize closing cost, or if we are minimizing the closing cost, or with a 0 closing cost, then will we end up paying more on the the monthly payments, EMIs?
Yes. So when you do no closing costs, no bank will pay from their own pocket. They can say all they want that, hey, I'm giving you no closing costs, I'm doing you a favor. No, they're not. They're making more money by increasing the interest rate. That's how we all do it. There is no rocket science to it. Just think of this. You go buy a car and this is 0% APR. Is it really 0% APR? No. They calculated the cost of the interest in those terms and they add it to the price of the car, and you don't know the price of the car. That was 18,000, now it's 22,000, but it's 0% APR. Doesn't mean you got a good deal. How to compare what makes sense? I do recommend no closing cost loan myself. Reason for that is, let's say if your interest rate go up by 0.125 with no closing cost loan. Difference in payment, of course, depends on the loan amount. Let's say if it's $300,000 loan, and difference in payment is $25, and your closing cost is $2,000, right? 2,000 divided by $25. It's going to take you years to break even that closing cost. That's the reason I recommend no closing cost loan, especially with our Indian community. Reason for that is we're always on the go. In 2 years, 3 years, 4 years, job change, we're moving, this going on, that going on. So I rather save my money now than thinking I will save my money in the future after 7 years, 8 years. So it's more logical decision than just looking at the interest rate and the closing cost. There are times, and closing cost changes in different states, different counties, depending on zip code. Some, if you look at all East Coast state or Florida or Texas, the title costs are 2, 3, 4 times than what we have in Missouri. So it does make sense to do no closing cost loan because the break-even point of the difference in payment divided by closing cost is so long. Like I said, I'd rather take my money now than saving money after 7, 8 years, because I don't know after 7, 8 years, even if I have this property or loan or not.
Okay.
So paying closing costs for lower interest rate only makes sense if you know, hey, I'm here for the longest time possible. And how do you decide that? Again, depends on your life, your family. If you have kids that are going to college, and then you know you got a big home, you're going to downsize, you're going to sell, or you may move because your kids move, right? So you're not going to save in the long run. You're going to lose money in the long run. So there is no straightforward situation. It depends on everybody's situation. If you're a young guy, definitely don't pay closing costs. If somebody makes $100,000 and they're 32 years old and they just got married and they don't have any kids, and in 2 years they got a job offer to make $200,000 and they got to move to Texas, all the closing costs are paid, went to rest. Anything upfront costs with upfront PMI, upfront closing costs, I do not recommend that. Now, if you're in your 40s, 50s, kids are done, you know you're not going anywhere for the job, you settle, you want to retire, and you know you're going to be in the house for long term, it does make sense in that case.
Okay.
Does that answer your question?
Yeah, that's perfect. Yeah.
So I have 2 more questions. Probably if no other questions, I will raise those questions.
I will ask one question.
Yeah.
Sure.
Go ahead, Ramki.
The question is like, is there any time period like between the refinances? Say like if I did like this month, is there any timeline like I need to wait to do the next one? Say like today if I'm closing by 2.5 or 15 years, the next month like say like if it comes down like 0.5, like say it's 2 years, 2%. So is there any time limit between the refinance, whether I can do next month or I need to wait? Or
So usually 6 months. Now, there is no hard and fast rule on that. The reason it's 6 months, so let's say if I did your loan, for example, and you refinance in less than 6 months. Basically, I paid your closing cost. Whatever money I made, I have to give it back to the bank. So it's a loss proposition for your lender in that case.
even like if we people paying the closing cost.
Correct. Especially if you pay the closing costs, you should not do it. So it's more of an ethical question, to be honest with you. If you want your previous guy, your lender, to suffer because they're going to have to pay all their livelihood, whatever they made, and spend all the time and effort on it. And now they got to give it back to the bank they sold the loan to.
Okay. So honestly, it won't impact the borrower. It will impact the lender. Okay.
Correct. And eventually, when all these things happen, to be honest, in the end, everything goes down to consumer, right? It just keeps happening over and over again. The banks will start increasing their rates and margins to recoup all their money. Then everybody else gets higher rate. So it's more of a social society issue than just looking after the borrower. Like, I don't know if you guys saw the news or not, Wednesday, the government imposed a refinance tax. So now we got to pay 0.5% fee on every single loan we close. Why that came? Because of all this refinancing over and over and over again.
Okay.
And I won't be surprised if more changes come to that to stop that, because that's hurting overall financial system.
Right. I think, Bibo, I have a question on that. Like, is that the 0.5% fee starts from like September, right?
Correct. So, correct. So basically what happens is when we close the loan and we sell it to the big banks. So let's say if I close the loan Friday, it's going to take me 2-3 weeks by the time they buy the loan and everything. The September 1st deadline is any loan that is sold to government, Fannie Mae or Freddie Mac, after September 1st. So banks not going to wait anymore. They already start charging because they know this loan is coming and they're going to have to pay 0.5% on our behalf. So they're not going to do that. They're going to start charging us. They already started charging us any loan we close now.
Okay. So is it the lender, they're charging to the lender or the bank? I think there was some confusing statements, like only the bank, it has been charged to the bank and not to the lenders, something like that.
Correct. But lenders go through those banks, right? So let's say all these big banks, Wells Fargo, Chase, I mean, they have billions of dollars of pipeline on any given day, right? I just talked to a bank yesterday, a big bank. They're locking almost $1.5 billion a day. So imagine 0.5% of $1.5 billion every day. Now what's going to happen? I can tell you the rate's probably going to go up because now they took a big hit and they're going to increase their rates for future clients so they can recoup all the money.
Sure. Sure. And also they said like it's going to impact only the FHA loan. So I didn't understand like what is that FHA loan or what category we fall under. So is
it's conventional loans too.
Oh, is it? Okay.
Yeah.
Okay. Because there are so many confusing statements. I don't know how it is impacting. So I thought of asking you, but it's good. Like we had a call today. So thought of checking with you on that.
Yeah.
So
and in the end, guys,
is it going to impact if I'm initiating the loan now? So even though it also said like the loan currently in progress, the application in progress will not get impacted, but only those who is initiating after September 1st will be impacting?
So there is no set policy yet. It's going to be company by company how they take it. As our company, we took a stance. We're not going to charge our clients because we made a commitment to them. It's not their fault. So as a company, we're going to take that loss. And that's one of the things to look at lenders, who you really trust. You're doing a big transaction when you're buying a home. That's probably your biggest purchase. Then you're refinancing. That's a big financial decision. Every bank is going to have their own stance. For us, loyalty to the customer and trust is very important. And I can see that banks, I already get calls from other people. They were locked somewhere where they're charging the clients, right? Because they're like, it's not our fault, it's the government's fault, blah, 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 put it on the customer. But it's not a customer's fault either.
Right. Because
so as a company,
that's what we were all thinking, like the most of the refinancing will be the people will withdraw the application if it is a 0.5, because most of the even I'm just refinancing for the 0.5 and above. So, right? Yeah.
So think of this, guys. It's a vicious circle.
Okay.
So in the end, it's impacting consumers. So when we do these loans, we sell it to big banks sell it to Fannie Mae. and they bundle it up, they issue security against it. Who buys the security? Guess what? Your 401k, your pension, your hedge funds, they buy all these loans in the end because they're expecting that return. And when you refinance, right, they paid off the loan. Now that money is gone, they were expecting to make, right? In the end, they increase all that rates and everything to make sure they make more money in the future. If that's the case, it ultimately gets down to the consumer.
Sure.
So it's your own money, it's your 401k money that is buying all those loans.
I see.
Kripa?
Any other questions?
Bhuvadi said he has a couple of questions.
No, just one.
Yeah.
So will it differ when it comes to the customers? Like, will it differ the priority based on the loan amount?
We don't, but sometimes, to be honest, system becomes the way that lenders do that. Because at the end of the day, you know, as a consumer, you're looking after you. Hey, I got a better deal. I got this. I got that. Right. And then when craziness like this happens, banks have to look after themselves too. The amount of time spent on each loan, of course, depends on characteristic of the loan. But let's say if it's a very simple loan of $200,000 compared to $700,000, time spent is same, right? So in this market, they're like, hey, we don't want small loans, we want bigger loans. Because if customer is looking after themselves, bank's going to say, well, we're going to look after ourselves too, because operationally, they don't have enough people to handle all the loans that are coming in. Industry was built for X amount of loans. Now the amount of loans have went 5, 6, 7, 8, 9, 10 times. And the amount of people are the same. We could not find people fast enough to train and everything to come and do the job that takes 5, 6, 7 years of experience, right? What do? It's no different than when this whole thing happened and we couldn't find toilet paper. We couldn't find hand sanitizer. It's no different than that. Everybody wants to refinance, everybody wants cheap money, but there's not enough supply, there's not enough operational capacity that is helping the cause. And that alone is probably going to push the interest rates up because we can't handle it. I mean, we're working guys 15, 16, 17, 18 hours a day. And after doing all that, and let's say if customer walks away for 0.125, there's a lot of time, effort, and everything wasted, which could have went to the good customer who stick around, who's loyal and everything. So it's impacting everything. It's impacting entire industry. In the end, consumer is going to suffer one way or the other. We can do all we want. We can try as hard as possible. But in the end, it comes down to consumer.
Okay. Yeah. So maybe then lender would give the priority then. So
it just depends on every lender, their operational capacity, where they at. If they have more purchases than refinances, you know, some lenders focus on strictly purchase. They don't entertain refinance much. It just depends where they are. Like if a lender is located in California, where average loan amount is $500,000 compared to Midwest, where average loan is $200,000, their focus is California loans.
Okay.
Yeah.
Makes sense. So at this point, I hear or I saw news as in some of the lenders or originators, they are not taking any new applications. This is direct to your company or whatever. So maybe will you take any new applications for refinance or new purchase, or are you still taking, or just you close the door?
It changes every day, my friend.
Okay.
The changes we are trying to implement in technology side, operation side, those changes were supposed to happen in the next 2 years. And we are making those changes in 2 months. Then you're talking about training your operation people to new technology, right? Because if we don't have new technology, we can't handle all this. But if you do, then you got to train all these people to the new technology to handle all this. I mean, it's no different than the whole coronavirus started and there were no masks, there were no hand sanitizer. How do you handle all that overnight, right? Nobody can do loans from home. Yeah, we can all stitch the mask and everything at home to help the cause, but loans, that's not the case. And the biggest thing that we have to be careful, like as a company, our focus is quite a bit on security right now, where we're seeing a lot of hacks going on, a lot of fake companies starting mortgage companies, and they put their ads on the Facebook or whatnot to get the clients in. And next thing is they have every single bit of information of the client, and off they go. Company's gone. They sold all that information on the black web. Just how we got fake hand sanitizer, now we got fake mortgages. So as a consumer, you have to be very careful who you're giving your information to. I can take all the applications I want, but if I'm not able to do it physically, it's impossible.
Gotcha. Okay.
Yeah. And rates, guys, rates are not going anywhere. Feds have clearly stated rates going to be low for long.
So
People who refinance, go ahead.
no, now Santosh said we are getting the new rules like by adding 0.5%, all those things. So that might impact the rate, though the rates are going to be, but these additional charges might impact the borrower. Do you think that might impact the borrower, or just you said like some of the companies like you are going to take that loss?
Mm-hmm.
So that's the case. People they may want to.
It depends.
Yeah.
See, again, it depends on the industry, what stance they take. And who knows, government may come back in 2 weeks that, okay, sorry, disregard this, because industry is making a big deal out of it. That, hey, you shouldn't be doing this because it's going to impact the consumer.
Mm-hmm.
If there is no straightforward answer to it, and it's very new change, and who knows what happens next week or the week after. The government is basically putting their hands in every single sector that's making money to offset other losses of job loss. I mean, they're almost 10% mortgages are delinquent. And guess what? If they don't do this, look at the positive side of this. If there are more mortgage delinquent, the more foreclosure happens, right? Eventually, that's going to impact all of us. Why? Because the housing market prices will go down. So the government is trying to take all this money to make sure that doesn't happen. The housing sector is 1/3 of our economy. If that goes down, it takes a chunk of economy down.
Okay.
Yeah.
All right, Vibhu, thank you so much for answering all the questions. So probably other members may have, I will shut up.
Sure.
Prabhakar?
Another question is refinance advantages and disadvantages.
Mm-hmm. The disadvantage is the first point I had made, that my payment is going lower, right? People are taking decisions without thinking. The rates are down, I should just do it, just because everybody else in the country is doing it. When you refinance on the same term and your payment goes down, doesn't mean, again, you're saving money. Banks will not tell you, and again, our Indian people are more smarter than normal average person. A lot of people just do it because their payment is going down. They don't realize in the long run they will end up paying more interest. Because if you have already paid down your loan by 5 years, and now you're refinancing and doing another 30-year fix, of course your payment is going to be lower because the term stretched out again by another 5 years. And your loan amount is lower than where you started before. There are times I get a lot of cases it doesn't make sense to refinance, and I tell them don't do it. Why? Because they have already paid so much interest. If they do it again, and they don't want to pay the same amount of money like they were before, they're wasting money. Now, in some cases, if you really need that cash flow, person who is living paycheck to paycheck, and they got no option but to lower their payments because they got other bills to pay, it makes sense.
So, Vibhu, on that one, this is the same situation. Okay, so if you covered this topic, if you look at it like, okay, so I have a 30-year loan before, okay, with the 3.5%. Now I have a 30-year loan with the 2.75 or 2.5%. Okay, but in this case, you are saying, if let's say I'm going to stay in the home for next 5 years, from the cost of capital perspective, if I look at it, right, it is advantageous, right? Because
Correct.
anyway, I'm going to move out of the home. That's
Correct.
what I
so
thought.
basically, correct. So basically, in your case, when you're refinancing, keep making the same payment like you were before. Yeah. You don't have the cash flow issue, right? Keep making the same payment.
Yeah.
With that drop in the interest rate, all you're doing is that on the previous payment, the interest was X and the principal was Y. On the new loan, if you kept making the same payment, your interest portion would go down and the principal portion will go up.
Yeah.
That means you're building more equity, and when you sell the home, that's when you're going to get the savings back.
Yeah. That's what. Yeah. Go ahead, Ramki.
That's okay to ask about. So, is it an advantage to do the cash out based on the assessed value, the priced?
It depends on the need of the cash out. If you're disciplined with the money, I have people who refinance and they lower their payment and they go buy a new car, right? And that's waste of money. Now, granted, they may needed that new car, and that's the only reason they're refinancing. But if you take the cash out and you know what to do with that money, if you ask me, yes, I am. I just did it myself personally because I know what I'm going to do with the money. If I can borrow the money at 2.75% and I can make 5% off it, why not?
Exactly.
But make sure you're disciplined enough to do it. You put investment somewhere else and next thing is that backfired and now you're losing money on it, then it backfires.
Okay, makes sense.
That's a very good point. That's a very good point, Ramki. That's a good question and a good point.
Yeah, because if you're asking someone, they're asking like, do you want to do a cash out? So, and then like I was like exploring what is the thing like for cash out. Is it really beneficial or not? Suppose if I'm paying like 4% interest in some other loan, say like some car, and then if I'm doing a refinance for 2% on my home, and then if I'm getting 40,000 cash, then that's a good option for me, right? Just like instead of paying 4% there, just get a 2%, pay it over, and then close that loan, and then stick with one loan. I was asking in that
Correct. In that case, I would do. Now, remember, for cash out rates are a little bit higher than refinance, but not much big difference. Depends on the value of the property too. But the example you just described, yeah, it would make sense to do that. And also, you got to look into the tax benefit too. I mean, it gets very complex, guys. If you want to make it complex, it gets very complex because now you took the cash out, you're going to pay more interest on the mortgage, right?
Correct.
Well,
that's true.
The tax deduction is capped now, right? And you're paying off your car loans and everything. Yeah, it would make sense if you have a credit card which has 10-15% interest rate. It would make sense. But if you leave that bracket of tax, then it's really not benefiting you.
Okay. Also, the other question what they're asking is if you are doing a refinance, they're asking whether like you want a cash out. And then they're asking if it is a primary home or if it is an investment property. If it is an investment property, like 0.25 or 0.5 might be higher. Like they're like telling all these things upfront. So, but the process is same, right? So, is there any insights between the interest fluctuations there between a property? Property is a property, right?
It makes a big difference in investment in the primary property. The reason for that is when 2009 crash happened, and it's always been like this. When you have a rental property, it's an investment, right? Let's say you have a primary home and you have 5 rental. Let's say economy crashes, you lose your job, right? And this is what happened in 2009, where people were buying left and right because values were going up and they thought they could time it and sell it, and all of a sudden it crashed. So banks have to go now foreclose on the property, right?
Okay.
The bank's cost can be up to 10% to foreclose on a property. Now they got to deal with the tenant who's living there, because you say, I'm done. Do what you have to do. Take over the properties, right? They're dealing with the tenant. They have to evacuate them. And before that, tenant gets pissed off. There are times when tenants just burn the whole house. They broke everything in the house. They turned the water on in the entire house. Guess what? Bank loses money, right? Now, if you have a primary home, your family is living there. You're not going to do that. You say, to heck with the investment properties, I'm done. Do what you have to do. But where your family is living, you're not going to do all those things. So the risk with investment property just goes up.
So that's what they're adding some extra percentages so that to cover those things. Okay, makes sense.
Correct.
Thanks.
Because you're depending on tenant too. If a tenant is bad, they're not paying money. In the end, you're losing money, right? And you say, hey, I can't do this anymore. Banks can have the property. Now they got to go deal with the tenant, the lawyers, and then laws come in that, hey, you cannot evacuate these people, blah, blah, blah. There's so many laws behind the scene. And all of a sudden, if bank did a loan for $200,000 and they got to pay 10% to foreclose the house, that's $20,000 right there.
True.
On top of that, they're not getting payments. On top of that, they got to pay the taxes for the property, insurance for the property.
Thanks.
So in the end, guys, it's a marriage between a bank and you when you're taking a loan. If the marriage is good, everything is good. If not, it's bound to break up. It's going to affect everybody.
But you didn't tell who is the bride and groom, though.
Well, you are the bride and the bank is the groom.
Okay. Okay. Thank you very much, Vibhu.
Sure. Any other questions, guys?
Santosh, Prabhakar?
No other questions, Mari. So all the questions are repeated in the list we have.
Not.
Good.
Yeah, thank you. Vibhu, it's already 3:05. So if not any other questions, really we like to thank you on behalf of Tamil Changam of Missouri and the members of the Tamil Changam. And thank you for your support.
Welcome.
Yeah, thank you.
Your support always, you are always supporting like our community, and it's really great. Like, thanks for
You're welcome. I would like to say one more thing, guys. And I'm telling this to a lot of my clients these days. Don't rush into a decision that may backfire. No offense. Don't do what friends are doing, because everybody's life, job, family is different. Do your homework before you do business with anybody. There's a lot of scam going on. I can tell you a lot of mortgage companies, IT infrastructure is so weak. I deal with them. I know those people. They're friends of mine. They're still dealing with documents in the emails. There's no security. One hack can lead to a big problem. A lot of these mortgage companies are outsourcing their mortgage functions. So all your information is sitting somewhere in India, Philippines, you name it. It's all over the place. So make your decision very carefully, please. But if you guys have any questions, feel free to email me. I'll try to get to it as much as possible, or send me a message on WhatsApp. I at least get 200-300 calls a day. I don't know how many WhatsApp messages, 600-700 emails, text, you name it. My daughter itself is starting to answering my calls. And she just says, because she's like, Dad, who is calling you guys? Are you just getting called? I get calls at 3 in the morning. Luckily, I'm awake, working, but physically, it has to stop somewhere. So, cool, guys. Well, let me know if anything comes up. Thank you for all your time and questions and everything.
Thank you.
Thank you very much.
Thank you.
All right.
Thank you, everyone.
Thank you, guys.
Thank you.
Have a good day.
Thanks everyone for